Hi everyone, my name is Risha and today is the 12th of March 2023 and I'll be going over my weekly prediction for SPX for the week ending the 17th of March 2023. Before going ahead with the video, I would like to make an important disclaimer that all information presented in this video is completely for educational purposes and educational purposes only, and it is unadvised to take any trades based purely off of the information presented in this video since markets are subject to risk, and it is extremely highly advised to consult a financial advisor before taking any trades based off of this video, since it is possible to result in hefty losses without informed risks. As usual, we'll be going over the monthly charts, weekly charts, and finally end off with the daily charts and option chain, and then I'll go over my prediction for SPX. So, let's get into it. As you can see from the monthly chart, finally the month of March has been able to go downwards from the strong resistance point for the past 3 months at 4104.44. We started to see this in February, where the market closed at 3970.15 and started at 4070.07. Very, very close to this resistance line as well. And then currently the month of March is continuing this downward decline by opening at 3963.34 and currently is at 3861.59. Additionally, we can see two very strong bearish candles where the month of March is currently in some form of an inverted hammer as of the moment. However, it has not yet closed. Similarly, for the month of February, we can also see that this was in some form of an inverted hammer, depending on the specifics of how much the tail should be in conjunction to the body. Well, the tail and the body are around the same size, which in most books would classify it as an inverted hammer. However, if the tail was any longer, yes, there would be a more definite candlestick pattern, but this is something that it resembles. From the monthly charts, we can gain an immediate support point, which is at 3836.80, and that also happens to be the close of the market 4 months ago. Now, as you can see, this is all that we can really gain from the monthly charts, along with a support further down the line at around 3758.35, which happens to be the low of this large red candle over here. And along with this, we can see that we have a clear downward trend line, which the market has rebounded off of in the last 2 months. Now let's move forward onto the weekly charts. As you can see, there was again a strong resistance point at around 4051.60 for the past 2 weeks, and then the market shot down extremely rapidly from, as you can see from this candle, breaking last week's no trade zone at 3902 and almost going all the way down to the next support, which is at 3836.80. So what do we gain from the weekly charts? There is no clear candlestick pattern for the week. However, it is a very, very strong red candle. Not quite a Mariposa because there's still a tail and a upper shadow. However, it is a extremely large body candle, which is red, and therefore it is a very, very strong bearish indicator for the market based off of pure candlestick analysis. From this also we can gain further reinforcement that the support of 3836.80 has been supported in the past, but from the weekly charts, this is all that we can infer. So let's end off the technical analysis by going over the daily charts. Now, as you can see in the prediction last week, I said that whichever direction the market breaks down from the support of 4002.42 or breaks up from the resistance of 4052.67 is where my prediction lies. As you can see, this clearly happened in the last 5 candles as the market started off going above, however it closed below, so almost caused a whipsaw if you took a premature trade, and then continued to absolutely break down every single support, specifically 2 support lines, which would have made a very, very strong profit for SPX, who took a short position at the time. Now, what can we gain from the daily charts? First of all, we can see a strong bearish sentiment in the last week, even more visually than the weekly charts, since it's all condensed to one candle. Here we can see the strong decline for the past week in the daily candles. Additionally, we can gain a minor support point at 38 99.64, which in this market would have acted as a resistance point. However, from last week's prediction, this candle line was extended into this week's prediction as well. Because last week this would have acted as a support, but now that it's been broken down, it acts as a strong resistance for the market for this week's prediction. So from this technical analysis, I can say firmly that the no trade zone for this week is 3836 and this extended line at 3900.19. And until and unless the market breaks either one of these points, it is unadvisable to take the trade as it is extremely volatile right now, especially SPX. And this concludes my technical analysis. So let's go over here to the option chain. As you can see, the highest CE for the monthly expiry date is now at 3900 and the highest P is also at 3900 with a minus 100 change in the CE and a minus 100 change in the PE, which has an ambiguous signal as both the CE and PE are less, so we can discount this altogether. The 3900 CE has a premium of 34.80, a 39 PE has a premium of 69.54, and a put to call ratio of 1.44. Next, if we go to the weekly expiry, we can see that yet again the highest CE and highest PE are both at 3900 with a minus 100 change in the CE and a minus 150 change in the PE. And yet again, the weekly expiry provides an ambiguous signal from the option chain as both the CE and PE are lower than last week. And the premium for 3900 CE is 35.81 and the premium for 3900 PE is at 74.08. And put to call ratio for the weekly expiry is 3.22. Finally, we have the daily expiry date with the highest CE at 3900 and the highest PE at 3850 with a minus 100 change in CE and minus 150 change in the PE. And yet again, gives an ambiguous signal. However, if you wanted to, since the PE reduced more than the CE, you could even take it as a weak bearish signal. And for the premium of 3900 CE, the premium is 8.75. And finally, for the premium of 3850 PE, it is 20 with the put to call ratio of 2.18. Now, you guys might be wondering why I drew this line at 3900 and I extended it. Well, this is why. Because 3900 is the strongest resistance point at the moment from the option chain. Therefore, although not entirely supported by the candlestick chart, it is very important to draw this as well. This shows the market sentiment that comes from the option chain. And this is why, yet again, my no trade zone of 3900 and 3836 is reinforced as the no trade zone, and whichever side the market breaks out or breaks down from is where my prediction lies. As you can see from the option chain as well, 3900 has been the staple in both the monthly and weekly charts and even for one spectrum in the daily expiry date. So from this, we can see that there is no clear signal that is given from the option chain, therefore reinforcing the need for a trading range, as there's no clear sentiment this week as much as there was last week in terms of the bearish decline. So, yet again, I'm going to reiterate that this week is a trading range breakout weight, and until and unless this is broken, it is highly unadvisable to take a trade. And on this note, I would like to conclude the video, and I'll see you in the next week going over the review for Prediction 15.